Your neighbor Bob is 70, retired. Most mornings he's out watering his roses before you've even found your keys. You're 50, still commuting, still meeting deadlines, still watching your paycheck disappear before you can decide what to do with it. Last year, you both made roughly $100,000. You handed the IRS $15,393. Bob handed them $290. Same country, same income. One of you paid 50 times more in federal taxes than the other. I remember the first time I saw something like this. My uncle's tax summary sitting on the kitchen table next to a half-empty coffee cup. I assumed his accountant had made a typo. That kind of number didn't make sense to me. I went back and checked it twice. It wasn't a typo. IRS code, working exactly as written. So what's actually happening here? It's not a loophole. It's not a tax shelter. It's the difference between how working income gets taxed versus how retirement income gets structured. And if you're 45 or 50 and you don't understand this distinction yet, you could spend the next decade grinding toward a retirement number that's 10, 15, maybe 20% higher than what you actually need, just because you're calculating it with the wrong tax lens. I spent years focused on the wrong number entirely. Not how much to save, but which pockets to put it in. So, how does Bob do it? And more importantly, if you're starting now, how do you build the same setup before you get there? Let me introduce you to Mark. He's 45, works as an engineer, makes good money. Every 2 weeks he opens his pay stub, and there it is, that line item sitting right above his net pay. FICA $612 gone. Just like that. Before he touches a dollar. For years, Mark assumed that number would follow him into retirement, that it was just part of the deal, part of being an American earner. It isn't. The moment you stop receiving W-2 wages, FICA disappears completely. Social Security tax, Medicare tax, both of them. That's 7.65% of every working dollar, not deferred, not reduced. Gone. On a $100,000 income, that's $7,650 that simply stops being taken the day you retire. That's the first layer of why Bob's tax bill looks the way it does. But the second layer is even more interesting. Most people know about the standard deduction. What fewer people know is that the IRS gives you a bonus deduction when you turn 65. For a married couple filing jointly, the total standard deduction can climb past $46,000 once you factor in the enhanced senior edition. That's over $46,000 of income that gets completely shielded before the IRS even starts calculating what you owe. Compare that to where you are now. Working couple, standard deduction around $29,200. The gap between those two numbers is real money. Thousands of dollars a year in taxes you simply won't owe anymore. Not because of anything clever you did, but because of how the tax code is written for people in that life stage. I used to think I needed to hit a $3 million retirement number to sleep at night. I ran the projections assuming my retirement tax burden would look roughly like it does today. That math was completely wrong because I was applying a working person's tax lens to a retired person's financial life. The two situations are structurally different. Retirement income, Social Security, investment withdrawals, pension, doesn't carry FICA. It benefits from larger deductions. And if structured carefully, it can flow through the system at a fraction of the rate your current paycheck does. Which means you probably don't need to replace 100% of your working gross income to maintain your current lifestyle. Most people need closer to 75% because a significant chunk of what you earn today goes straight to taxes and work-related expenses that simply won't exist when you stop working. That changes your retirement number, sometimes significantly. One thing worth saying plainly, if you've been quietly panicking about whether you're behind, you're not necessarily behind. You may just be using the wrong calculator. The financial industry doesn't have a strong incentive to point this out. the more anxious you are about your balance, the more actively you're contributing, and the more in fees they collect. That's not a conspiracy. It's just how the incentives line up. So that's the first mechanism. The tax drag from employment income starts to fall away when you retire, between FICA evaporating and deductions expanding. But that's just the foundation. The real structural advantage comes from the second bucket, the one where your tax rate doesn't just drop, it hits zero. But there's another piece that most people, including people who've done everything right, walk right past. Jane is 67. She and her husband have been retired for 2 years, and they've mostly figured out the rhythm of it. Quieter mornings, less calendar pressure. A garden that's finally getting some attention. This past spring, they decided to take a trip to Europe. Something they'd been putting off for 20 years. The rough budget, $20,000. Jane called her accountant before booking anything. She wanted to know how much to set aside for taxes before pulling money from their brokerage account. The one with the ETFs they'd been holding since their mid-40s. The accountant paused for a second, then said, "Nothing. You don't owe anything on that withdrawal." Jane thought she'd misheard him. She hadn't. Under current IRS rules, if your taxable income as a married couple falls below roughly $94,050, your long-term capital gains rate is exactly 0%. Not a reduced rate, zero. Stocks, ETFs, index funds, assets held longer than a year can be sold at a gain, and the federal government takes nothing. Think about what that means in practice. Jane and her husband have Social Security coming in, covered mostly by the standard deduction. They have a small traditional IRA they're drawing from carefully. And then they have a taxable brokerage account sitting there full of appreciated assets that they can tap at zero federal tax, as long as they stay inside that income threshold. That's not a loophole. The tax code is designed this way, for people who planned ahead. The common assumption is that the IRS notices every dollar. With the right income mix, that's not quite how it works. A lot of your actual purchasing power can flow through at zero. Your effective tax rate on that $100,000 retirement income can land in the low single digits. Sometimes lower, not because you did anything aggressive, because you built the right buckets before you got there. That's the 0% zone. And it's real. Here's where it gets uncomfortable, though. A lot of people watch this kind of analysis and walk away thinking the move is simple. Just max out the 401k, let it compound, and figure out the rest later. After all, you get the tax break now, the money grows tax deferred, and eventually you're in a lower bracket anyway. That logic sounds reasonable. I thought so too for years. It's also how people end up with no flexibility later. Because there's a version of retirement where you've done everything, right? By conventional advice, saved consistently, hit your number, followed the standard playbook, and you still end up paying taxes at a rate that surprises you. Not because you were careless, but because all your money is sitting in one type of account. And when all your money is in one bucket, you don't have choices. You just have withdrawals. That's the part we need to talk about next. Sarah is 60, divorced, lives alone in the house she kept after the settlement. She has $1.5 million saved for retirement. That's a real number. Most people her age would look at that balance and feel a sense of relief. Here's the problem. Every single dollar of it is sitting in a traditional 401k. When Sarah needs money, a new roof, a car, a medical bill, she has no choice but to pull from that account. And every dollar she pulls gets treated by the IRS as ordinary income. Same category as a W-2 paycheck. Same tax brackets. It doesn't matter that she spent 30 years building that balance. The moment she touches it, the meter starts running. Last year, she needed $85,000. Between the withdrawal, her Social Security, she crossed a threshold she didn't know existed. Her federal tax bill was higher than she expected. That part she could absorb. What she wasn't prepared for was the letter from Medicare. Her premium had nearly doubled. I've sat with situations like Sarah's more than once. A few months ago, I was going over finances with a cousin who'd recently lost her husband. She hadn't changed her spending, hadn't changed her investments, but her filing status flipped from married filing jointly to single, and suddenly her entire tax picture looked different. She wasn't doing anything wrong. The system just treats those two situations very differently, and nobody had warned her that the transition itself would cost her. That's the single filer penalty, and it doesn't get talked about enough. When you're married and filing jointly, your standard deduction is roughly double what a single filer gets. Your tax brackets are wider. The income thresholds for capital gains, for IRMAA, for Social Security taxation, all of them are more forgiving. The 0% capital gains threshold for a married couple sits around $94,050. For a single filer, it's roughly half that, around $47,025. Same income. Single filer pays capital gains tax. Married couple pays nothing. That gap is baked into the code. It doesn't adjust for your circumstances. Widowed, divorced, never married, the math doesn't care. And then there's IRMAA, which stands for income, related monthly adjustment amount, but really it's just a Medicare surcharge that kicks in when your modified adjusted gross income crosses certain thresholds. In 2024, a single filer crossing $103,000 in MAG, I could see their Medicare Part B premium jump from around $175 a month to over $244. Cross the next threshold. It goes higher. An IRMAA is calculated based on your tax return from 2 years prior. So, by the time you see it coming, it's already locked in. So what does that actually cost someone like Sarah? Let's put a number on it. You could do everything right on your federal income tax return, zero federal tax owed, and still get hit with thousands of dollars in Medicare surcharges because MAGI and taxable income aren't the same number. A large 401k withdrawal, even one you needed, can push your MAGI across the line without pushing your actual tax liability in the same direction. Sarah did what most financial guidance told her to do. The 401k was the default. She used it. That's not negligence. That's what the system made easy. But because every withdrawal is ordinary income, every dollar she touches has the potential to ripple outward into her tax bracket, into her Social Security taxation rate, into her Medicare premiums. It's not just one tax problem. It's three things triggering at the same time, and most people don't see it until it's already happening. The trade-off of loading everything into a traditional 401k isn't visible while you're working. The contribution feels efficient. Lower taxable income today. More take, home pay, employer match on top. The cost shows up later when you have no flexibility, when the only move available is a taxable withdrawal. When you're 65 and the government tells you exactly how much you must take out each year, whether you need it or not. That's the RMD required minimum distribution. Starting at age 73, the IRS sets a floor on how much you have to pull from pre-tax accounts annually. You don't get to decide. They do. And every dollar of it is ordinary income. If everything's in one bucket, you don't get to choose how much to pull. The government already decided. What you have isn't a strategy. It's a withdrawal schedule. But here's what I want you to hold on to before we move forward. If you're 45 or 50 and you're watching this right now, you still have time. The window is open. You're not locked in. Picture two versions of yourself at 65. Same starting point. Same income during your working years. Same rough savings rate. The only difference is a set of decisions made somewhere between age 45 and 55 about which accounts to put money into. Version 1 sits down in December to figure out that year's finances. There's a spreadsheet open, a calculator nearby. The anxiety is familiar. How much do I have to pull from the 401k this year? How much will that cost me in taxes? Will this push me into the next bracket? Will it trigger a higher Medicare premium? The math works out. Barely. But there's no flexibility in it. Every dollar coming out is a dollar the government already has a claim on. Version 2 pours a coffee, opens the same kind of spreadsheet, and makes a different kind of decision. Taxes are a little higher this year, so the draw comes from the Roth account, tax-free, no impact on MAGY. Next year, if the tax environment shifts, the plan shifts with it. The brokerage account is there if needed, sitting on long-term gains that qualify for 0%. Same net worth on paper. Completely different experience of retirement. The difference isn't how much they saved, it's how many choices they still have. That's what tax diversification actually means. Not spreading money across asset classes, spreading it across tax treatments. Building a retirement where you're not at the mercy of whatever bracket you happen to land in, or whatever Congress decides to do next. The fragile version of retirement is one where all your income is pre-tax and mandatory, where the government sets the withdrawal floor and you spend your fixed income years optimizing around a schedule you didn't write. The resilient version is one where you have optionality, where a bad tax year doesn't automatically mean a bad financial year, a bad year in the market, an unexpected medical bill at 68. Whatever it is, you can absorb it without being forced into a taxable withdrawal at the worst possible moment. At age 73, the IRS requires you to start withdrawing from traditional pre-tax accounts for 401ks, traditional IRAs, whether you need the money or not. The amount is calculated by a formula based on your account balance and life expectancy. You don't get to negotiate it, and every dollar of it lands as ordinary income on your return, potentially triggering the cascading effects we just walked through: higher brackets, higher Medicare surcharges, higher taxation on Social Security. One group spends those years managing the damage. The other group has options. The cost of not diversifying your tax exposure today isn't a number you'll see on a statement. It's the slow realization that you need $10,000 for a medical bill, but every dollar you pull has tax attached. It's the absence of options you'll notice at 65, 70, 75. You followed the path of least resistance the system was designed to offer. That's not a character flaw. It's a structural outcome. But you can change the structure. And the time to do it is while you still have working income, Roth contribution eligibility, and enough runway to let the buckets build. You can't control what happens in Washington, but you can decide tonight which account gets your next dollar. Tonight, open your retirement app, the one from your employer. You'll probably see one button front and center. Contribute to traditional 401k. Maybe a percentage field, maybe an auto escalation toggle. The whole interface is designed to funnel you in one direction, because that direction is simple to administer and easy to explain at an HR onboarding session. It is not necessarily the direction that serves you best at 70. So here's the blueprint: 3 buckets, each one taxed differently, each one serving a different purpose in retirement. The goal isn't a perfect ratio. It's having enough in each bucket that you actually have a choice year by year, based on what the tax environment looks like. The rough target to work toward is something close to 33, 33, 33. Equal weight across all 3. You won't hit it perfectly. That's fine. The direction matters more than the ratio. Bucket 1, pre-tax, traditional 401k, traditional IRA, keep contributing here, but only up to your employer match. If your company matches 4%, contribute 4% and stop. The match is a 100% immediate return. Nothing else in personal finance competes with it. Beyond the match, though, you're just building a larger pile of future ordinary income. You're deepening the problem we've been describing. Don't overfund this bucket. Bucket 2, tax-free Roth IRA, Roth 401k. This is where your additional savings should flow. You'll pay income tax on contributions now at your current rate, but the growth is tax-free. The withdrawals in retirement are tax-free. That part most people know. Here's the piece they don't. Roth accounts don't count toward your MAGI calculation the way traditional withdrawals do, which means they don't trigger IRMAA. They don't push your Social Security into higher taxation territory. They're essentially invisible to the formulas that cause the phantom tax problem. If your income is too high for direct Roth IRA contributions, look into whether your employer offers a Roth 401k option. Many do now. Bucket 3. Taxable brokerage. Open a standard investment account if you don't have one. Not a retirement account, just a regular brokerage. Put index funds in it. Hold them long term. This is your most flexible bucket. No contribution limits. No RMD requirements. No mandatory withdrawal schedule at 73. And if your income in retirement stays below that $94,050 threshold for a married couple, the long-term gains you pull from here are taxed at 0%. This is the bucket that gives Jane her European vacation without a tax bill. Yes, redirecting money into buckets 2 and 3 means your taxable income is slightly higher right now. You lose the immediate deduction you'd get from a larger traditional 401k contribution. That's a real short-term cost, but you're buying something with it. You're buying flexibility, the ability to manage your own tax exposure in retirement instead of having it managed for you. The ability to absorb a policy change, a life change, a bad market year, without being forced into a taxable withdrawal at the worst possible moment. That trade is worth making. At 45 or 50, there's still enough time for the buckets to build into something real. The system defaults you into one bucket. Building 3 takes a deliberate choice, made once, and then maintained. That's the whole blueprint. I don't have a crystal ball. I have no idea what the tax code looks like in 2035 or 2040. Congress could raise rates, they could lower them, they could restructure brackets entirely. Anyone who gives you certainty on that is guessing, including me. What I do know is this: the people who will be least affected by whatever changes come are the ones who built options before the rules changed. Not the ones with the biggest balance. The ones with the most flexibility. That's the whole point of the 3-bucket approach. Not to predict the future. To make yourself harder to corner by it. You can't vote on tax policy from your kitchen table, but you can decide tonight which account gets your next dollar. So here's what I'd ask you to do. Pull up your retirement accounts. Just the summary screen, nothing complicated. Look at the percentage sitting in pre-tax accounts versus everything else. If it's 90% or more in traditional 401k or traditional IRA, you now know what that means for your future options. That number is your starting point, not a verdict. Drop it in the comments below. What percentage of your retirement savings is currently in pre-tax accounts? Let's look at it together. And if this kind of analysis is useful to you, the mechanics behind the numbers, not just the numbers themselves, subscribe. There's more of this coming.